Already on this channel, I've shown you 2 high probability patterns and setups that I use every single day, which are completely mechanical and they're strict on their rules. But I think it's very important that you understand what a low probability setup and pattern actually looks like so you can avoid unnecessary losses in the market. So I'm going to show you 2 simple low probability signs that you can find so you can avoid unnecessary losses. And the first one is going to be when price obviously makes a normal fair value gap continuation setup. This is going to be a fair value gap continuation setup to the upside. And this is a FVGC with no FVG. That's what I like to call this pattern. And price obviously goes up like this, giving us our indication that price is bullish. So what it does is it makes our swing high. Price then retraces lower into a bullish fair value gap, which it respects. We do then get our closure above that previous candle high. Right here, you can see that we did end up closing. However, price on the entry candle, the one that we're expecting to enter on, actually sweeps the swing point right here. We actually sweep the swing point and close beneath this level. This is the first sign that price has now given you a low probability. You will figure this out before the candle even closes before you enter it. Yes, some of these setups actually do work, but it's better to avoid it in the long run so that you can actually be consistent and maintain a high win rate. You really don't want to be forcing these types of setups because when price does sweep liquidity like this, that's essentially what it's doing. There was resting orders above here from sellers getting in too early. Price then comes out and fills out, fakes out buyers to the upside, takes the stop losses of the sellers, and then price is more inclined to move lower instead of higher in our favor, which we would want, and obviously stop us out. So you really don't want that to happen at all. You want price to not sweep that swing point and remain underneath. Even if it did sweep the swing point, you would still want the candle at the end of the day to close through the level, right? With an expectation like that, where it wanted to close through the level with a body. That's it, all right? And that's the type of thing that you would kind of want. But when price obviously gives you this indication that price is now swept this level, that's a very high risk trade and price could reverse, stopping you out. The second sign that price has now given you a sign of low probability has to still do with our entry candle. It always does. That's the thing. And when price has now gone up, it's given us our signal that price is bullish. We've given our retracement swing high. Then we're given our retracement swing low. We can see that price has now actually respected that bullish fair value gap right there. And now we get that candle closure above previous candle high. And you're thinking of longing right there on the closure. But price then goes ahead, right? And before it closes, makes, let me mark it out, equal highs right there. Ends up making equal highs with the swing point. This is a horrible thing because what this does is it's now generating liquidity, right? It is not strong enough for price. This should be our signal that price is strong in the for the upside. But when we get equal highs like this, it now generates more liquidity. We don't take out the early sellers. We don't fill in those buyers, and we're generating now more liquid. So price is more inclined to go down and then later on come back up for that liquidity. But if you were to enter that, you would get trapped in that movement down, right? This is the number one sign of low probability that I would typically avoid. It's not as common as the one you just saw, but is a very, very strong reason to not get into the trade. So those are the only 2 signs of low probability that you really would have identified pretty often in terms of like very consistently or very easily identify. There's obviously some more things that I cover in my private side for you to avoid. If you do want to learn how to trade this model a little bit more, you can click the first link in the top of the description so you can learn all the ins and outs and everything I've collected data on over the past 3 years of trading. And obviously I've been testing this strategy live for around 17 months. Now, I know that's not a lot of data, but I have made a tremendous track record doing exactly so. So there's the proof in the product that basically this setup works. Anything can work as long as you understand how to trade NASDAQ direction, order flow, and have narrative every single time. So yes, we might be bullish right now, but with that sign of low probability, it's best to keep your money and not give it away and donate it to NASDAQ. So let's go take a look at a high probability setup on the charts and a low probability setup. So moving over to the chart, you can now see that I am on NASDAQ. I am in the session that I trade every single day live on stream, 9:30 to 10:15 Eastern Standard Time. It's only a 45-minute window, that's it. You can see that price is obviously starting to make some bullish movement. We are making higher lows and higher highs. But you notice when we have a setup right here, here's our pattern. So we get that indication that price is now moving higher and we have a potential trade forming. We get a fair value gap that price is respecting. All we kind of need is just to mark out this swing point, because we truly don't want any interaction with the swing point at all, right? The less interaction, the better. Unless it does close through, then that is completely fine as well. Now, when price obviously gives us our indication that we can trade, we're going to mark out our most previous candle, which is this one. We're going to play the next candle out. We did get that closure through that level. However, right, we did end up sweeping this high. So if you were to enter that trade, we did end up sweeping that high as well, right? And price, if I just was like to put my stop loss underneath the low there and just target a 1-to-1 or a 1-to-2, price would immediately stop us out pretty much in the next candle. Bang, it comes down. And no, it's not going to stop you out that quick usually. Like, that's obviously because, you know, there's a decent amount of volume on that specific candle or to the downside. But that is a low probability pattern in itself. And all you have to do is just simply avoid that setup as a whole. Just don't even touch that setup. So let me show you a setup that you actually should take. So here a little bit later on that day right there, you can see now price has created a bearish fair value gap. We're starting to make, you know, bearish order flow. We have a high, we're making lower lows, we're making lower highs. This is perfect. It's exactly what we want to see happen. Right here is our swing point, and right now we're in that little retracement phase. So this is our indication. We're retracing back up into this fair value gap and still respecting it. Here is our most previous candle low, right? And as you can see, if I play the next candle out, we do end up body closing through this level, right? We don't make equal lows with this one ever so slightly, and we don't actually sweep or interact with this swing point at all. This is perfect. This is exactly what you need. You can put your stop loss above the high there, above the swing high or above the gap, and then you can target a 1-to-1 or a 1-to-2 risk to reward, because now price is more inclined to go in your direction. Okay, it's followed a simple pattern with simple narrative and context. You'd be able to catch a very nice trade. 1-to-1, 1-to-2, whatever you need, whatever your consistency rules are on prop firms, or whatever you want to trade in terms of personal capital or anything, right? This is going to help a lot, especially when you're looking at lower time frame moves. You're going to see this setup present itself every single day, like at least 20 times a day, no matter what session you're looking at. Obviously in a 45-minute window, you're bound to get probably about 2 or 3 max. Sometimes I've seen is about 6 per 45-minute window. But let's just say on average 1 to 2 a day shows up. You're going to see either a low probability or a high probability. All you have to do is just make sure that you're following high probability systems and stay away from the low probability systems. So that way you can obviously increase and maintain a high win rate. So that is all I have for you in this video. If you liked this video, hopefully it was helpful. If you want to see more helpful content like this as well with the fair value gap continuation model, right, then let me know down below. Like the video, subscribe for more content. I'll see everyone in the next video.